Welcome to Bloomberg Markets. I'm Scarlett Fu. It is noon in New York, and we're seeing plenty of action across asset classes before some key economic data. The headline numbers, when you look at the equity market, kind of mask some of the action. U.S. stocks did give up some early gains, but they do continue to advance thanks to a strong forecast from chipmaker Micron. So the S&P up 0.4% right now. Precious metals extending their rally. We've been reporting on how gold is at a record high. Well, now silver is at its best level since 2012. 32.49. And little action right now in the Treasury market, the 10-year yield moving up to 3.80%. But plenty of price action in Chinese assets. You look at the offshore yuan, it's strengthening on reports China may inject $142 billion of capital into its biggest state banks. Now, already this week, Beijing has unveiled broad stimulus measures, including an interest rate cut. Let's go back now to equities for a moment and check in with Abigail Doolittle, who has some individual names that she's following. Abigail?
Well, some of that stimulus that you're just talking about out of China really boosting the tech ADRs, the China tech ADRs. Li Auto up 7%. You can see all of these names, in fact, some of the well-known China tech and auto EV names sharply higher on that new stimulus involving the housing market, the property market, along with a $142 billion boost to banks. This, of course, follows earlier this week when rates were cut and bank reserves lowered. So it's really a bazooka of stimulus helping out these stocks in particular. But it's not just China tech stocks that are trading higher. If we take a look at the shares of Micron, we are seeing a stock surging here. In fact, off of its highs, but still up a very healthy 13 to 14%. The best day in about 6 months. At the highs, up closer to 20%. At that point, the best day since 2011. They also boosted the guide for the first quarter. The top line by a healthy 5% better than the street. The bottom line, double digits better than the street. And it's AI demand really creating a new chip that they have relative to AI, helping out for memory, helping out these results. And then finally, on a Wall Street Journal report, we do have the shares of Supermicro down 16% right now. And this is the Justice Department has opened a probe. It follows a short seller report earlier this year related to a whistleblower who had been at Supermicro. The probe is in early stages, Scarlett. It's interesting. Earlier, this stock, before it was added to the S&P 500, up more than 300% on the year. Now it's up just 41%, still pretty healthy, but relative to more than 300%, not so much. And there is a big short interest on this stock, not surprisingly, 17%. So those bears in control today.
All right, good stuff. Abigail, thank you so much for those individual movers, and certainly something we'll keep an eye on. Of course, when you look at the macro environment, we're getting a lot of Fed speak today. I count 8 different speakers, including Jay Powell. Plus, we get PCE inflation data out tomorrow. Now, earlier today on Bloomberg Television, Evan Brown from UBS Asset Management gave us his take on where he thinks things stand right now.
I kind of think this is the best of all worlds, where they're supporting growth. Maybe inflation becomes more of an issue if we get Trump tariffs and the like down the road. But I think that's, kind of tomorrow's story as opposed to today.
Tomorrow's trade as opposed to today's. Let's focus on today's market action and where things stand going forward. Let's bring in Nicole Inui. She is head of equity strategy Americas at HSBC. Nicole, thanks for joining us today. If the S&P 500 does close higher today, I believe this will be the 42nd record close of 2024. All 11 groups are gaining so far this year. What's been the most underappreciated or surprising aspect of this broad advance?
Well, I think, what you're saying about the S&P reaching record highs, all the pieces are falling into place. So we're seeing the Fed cutting 50 basis points, so they're front loading these rate cuts. You're seeing GDP growth that actually is looking pretty resilient. The labor market's looking okay. The consumer's looking okay. And what the companies are saying in terms of the commentary, if you look at second quarter, was pretty positive, and you haven't seen analysts revising higher earnings. So on this kind of macro basis, everything is looking extremely strong. I'd say the one big pushback we get, of course, is valuation, because at the end of the day, you're paying a price for these equities. And what we're seeing is, of course, the S&P is trading at a hefty premium to where it's traded historically, even looking at certain sectors, even taking out the Mag 7. You are seeing the S&P trading at a premium. And so we think there's opportunities kind of look beyond these high premium, high equity valuation stocks into other cohort of stocks that have less demanding valuations.
So walk us through what your work shows on valuations in sectors outside of big tech, because clearly big tech has been the leader and it's gotten all the attention. But you mentioned that, especially with all the 11 sectors in the green, there's been some notable valuation, not inflation, but increases in sectors that you might not anticipate.
Yeah, definitely. So if you look across about 7 of the sectors, you're seeing these sectors trading at a premium of more than 10% of what we've seen historically. But what we've noticed is that it's really concentrated. So we've talked about this big tech concentration, Mag 7 concentration year to date, but it's also big retail, big pharma, big oil. So if you look at consumer staples, for example, 80% of the returns year to date are from 3 stocks. Pharma, healthcare, you have a very similar story. So what we're seeing on valuation is you have these stocks that, yes, have performed very well. Yes, their earnings growth has been strong. Their profit margins have been very good. And they've been responsible for much of the returns, but they're also trading at very premium valuations. So the market is paying up for that. So we think this is part of the reason why you're seeing kind of this loftiness in terms of the valuation because of this high concentration. And that as we've recommended broadening exposure into different sectors, we also recommend broadening exposure into different stocks within each one of these sectors that haven't been the stars year to date.
Which metric would you look at to determine which kinds of companies provide the most value? Does it go beyond PE? Does it go to price to sales, for instance, or something else?
No, definitely PE, price to book. We're looking at where these stocks are trading compared to the sector average. We're looking how earnings growth is shaping up for this year, for next year, and you're also looking at kind of leverage ratios. So you're looking kind of at those quality plays. So these are stocks that are analyst-like, and they're across a broad range of sectors. We see some in financials, consumer discretionary, even tech. There's stocks that we see that we think provide good value and less demanding valuations as some of these other higher valuation, premium valuation stocks.
Well, let's talk about some of those higher premium valuation stocks, and that would be, of course, big tech. In recent weeks, we've had NVIDIA, we've had Broadcom, and of course, yesterday, Micron reporting results. And market reaction to these AI plays has been pretty much mixed. What is the narrative on AI right now?
We're still positive tech. I think it's going to be less of an outlier going forward. So, again, we've had this concentration of this rally year to date, very focused on big tech and these other big companies. And so what we're saying, looking over into the second half of the year, you're seeing strong earnings growth in other sectors. Again, tech, you're still seeing very high ROEs, very high profit margins. So this higher valuation is deserved, and these rally in these stocks is deserved. But we're looking into other sectors and broadening, and a little bit less of an outlier than what we've seen in kind of the first half of the year.
Does the broadening out include small caps? Because they were getting a big run up in the anticipation that the Fed would cut interest rates. Now that the Fed has actually done that, do we need to rethink the thesis behind small caps?
Sure, that's a great question. So we looked at small caps, and we're not ready to go into small caps yet. What we've seen historically, small caps tend to outperform going into a Fed cut, and then they tend to underperform post when the Fed starts easing. And this is in 2 scenarios. Even when a recession doesn't materialize, these small cap stocks tend to underperform. And what we look at, you look at the small cap stocks compared to what we're seeing on the large cap, and there still is a big, wide range in terms of profit margins, in terms of leverage. So, I think the quality is still there with the large cap stocks. There's some that have undemanding valuations, and we think kind of the gap is still too wide when we look at ROEs and when we look at profit margins of the small caps compared to the large cap space.
All right, so hold off on small caps and continue to look at big caps, but perhaps with a more discerning eye. Nicole, thank you so much. Nicole Inui from HSBC. Now, coming up, we've got an exclusive conversation next with the CIO and founder of Universa Investments, Mark Spitznagel. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. Now, most investors cheered when the Fed last week finally began cutting interest rates, but not necessarily Universa Investments CIO and founder Mark Spitznagel. The hedge fund manager said this summer that the cut would mark the moment when things would get really awful. Bloomberg's Sonali Basak is standing by with Mark for an exclusive interview to understand where his thinking lands now. Sonali?
Thank you, Scarlett. And Mark, thank you for joining us here at Bloomberg. And to provide a little context, Universa is known to be a tail fund. You tend to make money when things go wrong. But over the last couple of years, you and I have talked about this since then, that you actually were quite bullish. You thought that asset prices would just soar. And that when the Fed would cut rates, or you said a year ago, that's when things would go bad. You said that as recently as a couple of weeks ago. Do you still feel that things could be terrible? We're sitting here at all-time highs, and it seems like nothing could go wrong in this market right now.
Well, right now, it's good to be here with you, Sonali. Right now, I remain pretty positive, as I've been, as you said, for a couple of years. I just look back to 22, 2 years ago, and I just think people got that really wrong. The general thesis back then was that we were in the 70s. And I just think that was so misplaced. The 70s was a very different time than now. The big difference, of course, is that we have more leverage in the system right now. We have this debt construct. So I just think that people were making a big mistake. The sentiment was so negative. The way I have described it is we're in this sort of Goldilocks zone, right? I think other people can recognize that. And what a Goldilocks zone is, it really is sort of this first order consequence of what's going on today. Rates come down, you've got disinflation, you've got kind of not too hot, not too cold in the economy, and people look at that and they say, oh, well, that's good. It's sort of a first order consequence. And that's okay, and we're really good at first order consequences as humans, right? So that's kind of where we are, and I think this is going to continue more into sort of pure euphoria before it's over.
So does that mean you think we'll hit ever more record highs over the next year? How long does that euphoria go on for?
So I wouldn't necessarily say over the next year. My opinion is that towards the end of the year, we're going to exit this Goldilocks zone. But really what's driving this isn't these sort of first order effects. It's really, we have to think, I think, more about second order effects. And that's something that we're just not as good at, is first order effects. We really need to look back to 22 and what happened there. I mean, that was a massive hike. That was a massive tightening that happened in the economy. Personally, I thought it was an enormous mistake at the time. And which, of course, makes me look a little bit like a Fed apologist, which nothing could be further from the truth, because you'll never speak to a bigger critic of monetary interventionism than me, of course. But I thought that was a big mistake, and the second order effect of that is what we're feeling right now. But really, I think there are higher order impacts that is causing all this, and that's what happened 15 years ago. I mean, it really was the Bernanke era that got us to where we are, but it's really so easy for us to forget that. There are lag effects. That's what second order effects are. They're lag effects. And we're starting to feel that in the economy.
Well, explain that, because right now we are no longer at the beginning of 2022. We are not in the Fed hiking cycle. We're exactly at the opposite place right now. We are beginning that cutting cycle. So what happens now, in your view?
Well, when the yield curve disinverts and then uninverts, the clock starts ticking. That's when you enter black swan territory. Black swans always lurk, but now we're in their territory. And I think that's the way we need to think about it. And that's why I think that's a little misplaced to think that lower yields right now is a good thing. That's why I said earlier that when yields start going down, Fed starts cutting, that's when we actually should start to worry.
Now, for those who don't know, Universa is counting Nassim Taleb, the Black Swan author, as scientific advisor. And so you guys know a little bit or two about black swans, but you tend to also make money when black swan events are occurring. How have you done this year, particularly because you did see some volatility in the market, some extreme volatility in the market, but a lot of complacency too?
There's a lot of complacency. I obviously can't talk about performance. I never can do that. I'm not allowed to do that. But yeah, that's, we're in the risk mitigation game. It happens to be, through explosive downside payoffs that allow our clients to be longer. And we are there to protect the losses that matter to compounding. And that would happen to be the very big losses. But, the way I think people need to be thinking about investing right now, to sort of continue this, sort of dovetail into this sort of second order effect, is second order investing. That is, not thinking about sort of the opportunity set of investing right now. I think what people should be thinking more about is the opportunity set that they're going to see, let's say, a year from now. And that's kind of the point of risk mitigation, is to allow yourself the ability to do that.
Well, double down on what you mean by being in black swan territory right now. What are the big risks that you're seeing, and is there something investors are ignoring?
Well, the risks that the risks that exist in the market are those second-order effect risks that happened 2 years ago. And there's the distortion in the system. So it's not like a catalyst. These are always sort of narratives that we always come up with after the fact. It's really the environment. It's really the environment that we're in. So again, in thinking about risk, though, and thinking about risk mitigation, I think we need to think about it sort of in terms of what we're going to be able to do in the future. Not so much about what our losses are going to be now, but what we have the dry powder. That's really what risk mitigation is. Sun Tzu said attack is really the secret of defense. Defense is the planning of an attack. So we need to think about dry powder. But dry powder is a catch-22. It's a double-edged sword. It's good to have dry powder. It's bad to wait to deploy that dry powder. It's good to buy the dip, buy cheapened assets. It's bad as we wait to do that. So risk mitigation really is sort of trying to solve that problem. As the markets move away from us, risk mitigation can be the cure that's worse than the disease. So I think that's the way people need to start thinking about it.
What do you think about the way investors have been diversifying right now? You have been quite critical about the idea of investors flocking too much into one asset to seek insurance, the idea of gold hitting record after record as well. Do you think that that's the right thing for a portfolio right now?
Yeah, it's really what this is, I think, is sort of a superficial distraction. Diversification, modern portfolio theory. It's got people distracted into mean variance, into risk-adjusted returns, and these are things that have just made people poor over the years. It's sort of a solution looking for a problem in many ways. Diversification is not the holy grail, as it's been touted by many people. That is a big lie, actually. We need to think of our risk-mitigated portfolio or a diversified portfolio or whatever it is. We need to think about it in terms of what it does in bad markets, what it does in good markets. We need to be comfortable with both of those. We need to think about both of those two scenarios relative to if we had done nothing, if we were just in the market, right? And now we can start thinking about, in relation between these two, what this means about our compounding going forward. And this is something that when people really honestly assess, I think they would move away from diversifying portfolios.
How do you think people should be hedging in this environment? To the extent that you think things could get choppy or that there are black swans around the corner, what's the most appropriate way to hedge this market? It's
hard. I think gold's going to go down with stocks when this thing is over. So it's hard. Bitcoin, crypto is going to go down with risk assets when this thing is over. It's hard. We need to protect ourselves not from the market, but from ourselves. We need to forecast not the market, but ourselves. We need to think about what we are going to do in these two scenarios. Markets boom and bust. Markets zig in order to zag. It's like poker. They try to squeeze us out of our positions, make us sell the low, buy the high. So let's make sure we don't do that. There's not one solution for everybody. I'm not here to do that. But I think that's the way people need to think about it.
Well, let's just look at August 5th, rather. You saw the VIX just shoot past 65. You're back down to 15. It seems like things have calmed down. Do you expect a vol spike like that again?
Volatilities tend to follow realized volatility. So that's kind of what's going on there. But yeah, the vol markets, the derivatives markets are extremely inefficient. And of course, we love inefficient markets. The dealer community disappears when things get dicey. That makes sense. Again, we consider ourselves sort of the liquidity providing part of that liquidity providing function. So this works for us. So it's a very hard place to play. Yes, I mean the markets get unhinged when things move sort of outside of a range. This is the way the dealer community has to do this because they get long all this gamma because we've got this growth in vol selling funds out there. So that's just kind of how shaky the market is. And when things get unhinged, we expect vol to explode. And I think in the months ahead, in the year ahead, we should expect more of that.
Mark, great to talk to you at this moment. That, of course, is Mark Spitznagel. He is the CIO and founder of Universa Investments. Scarlett.
Thank you so much, Sonali Basak, Bloomberg Open Interest anchor, and of course, Mark, for joining her this afternoon. Now, coming up on Bloomberg Markets, an indictment has been formally announced against New York City Mayor Eric Adams, who today is responding to that indictment from the federal prosecutors. We'll have more on this developing story next. This is Bloomberg. Welcome to Bloomberg Markets. I'm Scarlett Fu. We're midday here in New York. Let's get a check on where things stand in equities and in treasuries. And you have modest gains in stocks. The S&P 500 up by 1/5%. The Philadelphia Semiconductor Index gaining ground, up more than 2% thanks to Micron and a fairly optimistic outlook. As for Chinese stocks, that's where a lot of the real action is happening, given China's latest announcement that, or I should say, are reporting that it is expected to unleash some fiscal stimulus that adds to the package of stimulus measures it announced earlier this week. The Golden Dragon Index jumping 10% on the day. And like I mentioned, modest losses in treasuries, so that is pushing up the yield on the 10-year by 1 basis point to just over 3.80%. All right, let's turn now to business as it pertains to the environment, because it is Climate Week here in New York, and President Biden spoke at the Bloomberg Global Business Forum about this.
And I've been pointing out, when it comes to the climate, every time I talk about it, whether I was trying to convince labor or business to come along, I'd say, I think climate, I think jobs. I think jobs, and I mean it. Good union-paying jobs. In fact, I'm proud to have kept my commitment to bring unions and business to the climate table. That's what we're seeing.
Consumer-facing companies from Chipotle to Hilton are vocal in their pledges to reduce their carbon footprints over the next few years. This is something we've seen and we've heard. Yet many of those same companies are actually key members of trade groups that have recently filed lawsuits to overturn some critical local and state climate rules. This is a contradiction that Bloomberg's Ben Elgin has been reporting on. And Ben joins us now from San Francisco. Ben, this is happening in states like Colorado. Can you give us an example of how companies' own climate policies are at odds with their participation in these larger trade groups and their legal efforts?
Sure, yeah, you've got companies like Marriott and Hilton that have pledged to cut their emissions by roughly half in about 6 years. And these are sort of the climate improvements that need to happen to stave off the worst parts of an overheating planet. At the same time, these companies have members or property managers in key positions within trade associations like the Colorado Hotel and Lodging Association. This association is filing a lawsuit, a part of a lawsuit that is trying to beat back rules in Denver and in Colorado that would require buildings to become more efficient. These requirements are, in many cases, less stringent than the company's own voluntary pledges.
What's the response from Chipotle, from Marriott, when you reach out to them and you point this out?
Yeah, a lot of times companies will say, hey, we do not control the actions of the trade associations we belong to. It does raise a question, though, that they, in all cases, don't want to address, which is, okay, well, what role did you play in the formulation of this policy? Did you advocate within this organization for your own climate position, or were you more than happy to go along with the trade association's opposition to these climate rules?
Is Colorado an outlier, meaning is the state's climate rules more ambitious than other municipalities?
It really isn't, and that's why we focused on it, because it's representative of really what's happening across the country. So in California, in the city of Berkeley, 5 years ago, was the first city in the country to halt the expansion of gas pipes into new buildings. And that's just sort of a baby step that has to happen if we're going to hit our climate targets. The gas system can't continue to expand. The California Restaurant Association filed a successful lawsuit to overturn that, and dozens of other cities have since had to similarly roll back their provisions here. So again, it's the restaurants and the hotels fighting these rules at a city and state level.
Ben, I'm curious, are there examples of companies that have pushed back against the trade groups?
Yeah, you know, and it's fascinating. This happened 15 years ago. The U.S. Chamber of Commerce was opposing all sorts of climate rules around the country. And Apple, the technology giant, had a very ambitious climate goal. And so they finally said, look, the U.S. Chamber, we can no longer continue to be a part of this and to fund your activities. And so Apple made a clean break. But by and large, these differences and these discrepancies just continue to linger and persist.
All right, Ben Elgin, fantastic reporting. Thank you so much for bringing our attention to this, especially on Climate Week. Ben Elgin in San Francisco. We want to go back to an equity mover that is declining, a big decliner, in fact, in today's session, and that is Supermicro, SMCI. It is reportedly under investigation by the Department of Justice, according to the Wall Street Journal. And this follows a report from a short seller earlier this year, Hindenburg, which raises questions about the company's accounting practices. We should mention that representatives of Supermicro and the DOJ did not immediately respond to requests for comments, but we did reach out to Bailey Lipschultz, who's been looking into all of this, and he joins us now. So, Bailey, what do we need to know about this?
The main thing, Scarlett, if you step back to the end of August, we saw the Hindenburg report coming out saying that there were misleading accounting practices. Then the next day, the stock plummeted after the company delayed its full-year financials, saying they needed more time. Now you fast forward just under a month later, now we're seeing this report from the Wall Street Journal about a Justice Department probe. So it does seem like these issues that Hindenburg first pointed out and then with the delayed filing are continuing to percolate. If you keep in mind, the stock is down about 31% from the Hindenburg report. Shares didn't really move on the report itself, but when you see a filing delayed, you see reports potentially of the Justice Department looking into it. That's causing investors to pressure the stock again. Worst day since that those financials were delayed.
How are you thinking about reporting this forward? I mean, how do you move forward from this? Anytime Hindenburg publishes something that's kind of bearish, the DOJ starts to take a look at things?
I don't know if it would go that far, Scarlett, but he definitely has weight. He took down Nikola. We saw the reporting about Adani and the issues there. We've seen him call out the likes of Block. So he does have weight and is the most prominent short seller on Wall Street at this moment in time, an area that we're seeing short sellers increasingly pull back from their bearish reports. So it's something we definitely keep in mind, keep top of mind. And I do think when you look at the filing from Nate Anderson, again, about a month ago, then you see the company delaying their financials.
Yeah.
That was really what resonated with Wall Street. And then again, you see the government stepping in.
Absolutely. So the other thing we should mention, of course, is Supermicro has been super popular with a lot of retail investors. I know that you cover meme stocks, and in part because it got swept up in the whole AI frenzy.
Yeah, we saw this, Scarlett. This was a stock that was about $2 billion in market cap a few years ago. And right now, even after this sharp drop off, it's still $22 billion.
Yeah.
So it's down 70% from a high, $60 billion in market cap. It is in that AI flavor. We have seen analysts, though, increasingly kind of point to what the path forward looks like. They are one of the largest customers of NVIDIA. Obviously, we saw the big news from Micron coming out showing that there is still so much AI demand. But the big question is when you look at kind of the hardware space, the storage space, the area that Supermicro plays in, those are thin margins. It's very competitive. And there is still some uncertainty about whether or not the company has come too far too fast. And when we spoke to analysts around the initial report, they kind of called it a company that went from being a teenager into being an adult. You go from about $2 billion in a small cap stock to being a member of the S&P 500. People are going to pay a lot more attention to you just because there's so much passive flows that automatically buys up the stock.
There's a lot of scrutiny, but then there's a lot of growing pains as well. All right, Bailey Lipschultz, really appreciate it. Bailey Lipschultz covering Supermicro Computer, reportedly under investigation by the Justice Department. Coming up, we're going to stay with equities because our stock of the hour went public today on the New York Stock Exchange under ticker BKV. The CEO, Chris Kalnin, will be joining us to talk about natural gas and the company's market debut. And a quick mention here of Hurricane Helene, which has unleashed tropical winds across South Florida. The storm is strengthening on a path to the state's west coast, where it threatens to push a wall of water onshore. Helene's tropical storm strength winds extend 345 miles. We'll be keeping an eye on this storm. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It's time now for the stock of the hour, and we're covering the debut of BKV. The gas-producing unit of Thailand's Banpu began trading after raising $270 million by selling 15 million shares at $18 apiece in its initial public offering. Let's head now to the floor of the New York Stock Exchange, where we find BKV CEO Chris Kalnin. Chris, I want to start with why you're going public now. What is it about the current market and macro environment that makes sense for you to list now when the U.S. IPO market has yet to fully recover?
Yeah, Scarlett, great question. You know, when we look at the markets today, we see that BKV is at the confluence of some of the biggest megatrends in energy. We have an incredible carbon capture business. We produce natural gas, and we can distribute that to the LNG corridor down in the Mississippi corridor of Louisiana. And we have power assets that can serve AI data center booms that are going on in Texas. So with the trends that are tailwinds to our business, we feel like the market is ready for a new kind of energy company like BKV, and we think the IPO success has shown that.
Well, the IPO price I mentioned, $18 a piece, is below the company's proposed range of 19 to 21. What do you attribute that to?
Look, you know, when you do an IPO and the market has sort of not had a lot of IPO volumes, you sort of feel the market out. You know, we set the price range with an expectation that we could be higher or lower depending on where the market was. You know, we're very pleased at where we are, 18. You know, we think there's lots of running room in the stock, and we're excited about the future. So we think at the end of the day, the market prices it, and we're just so thrilled that we got the IPO done, Scarlett.
All right, you had mentioned Louisiana, but your bread and butter is really nat gas production in both the Barnett Shale in Texas and Marcellus in Pennsylvania. I know you've sold off a chunk of your assets in Marcellus in 2 deals. Do you expect to exit Marcellus completely and focus all your efforts on Barnett?
Look, the Marcellus has been a great asset for us. We're located right between Chesapeake and Cortera in the Northeast Marcellus play. At the moment, our plan is just to run that asset for cash. We believe we can cash flow it for 10 years to come and more. Our core asset is, of course, our Barnett asset in the shale, as you highlighted. That's going to be where we're going to see production potentially grow if prices are supportive. And we believe there's a lot of additional inorganic opportunities in that area. So, again, we think we have a good portfolio. We're all operated now. What we sold was non-operated in Northeast Pennsylvania. So we'll maintain our operated position and just cash flow it.
And just to dig a little bit further into that, is there a conscious decision to be perhaps the biggest nat gas producer in the Barnett and avoid places like Eagle Ford and Haynesville because perhaps they're a little bit more costly to operate there?
Well, listen, we are the dominant player in the Barnett Shale. We're, you know, twice the size of the next producer, 800 million a day of gross production there. We love the Barnett. It's low decline. Our decline rates are market leading. And so that allows us to really play with our CapEx as prices come down or come up. We can toggle that. You know, when you look at the Eagle Ford or the Haynesville, the Barnett is really the leading indicator of where the gas shale plays are going to go. So we think at some point when these plays get to their midlife, BKV is ideally positioned to be the producer of choice to manage those. So, but at the moment, the Barnett has lots of running room, both organically and inorganically, and we feel like that's our home right now.
All right, well, given that, what sort of production growth are you anticipating this year? And you had mentioned CapEx. How do you expect that to look next year?
Yeah, so our whole CapEx program is driven by our price expectation. And when prices are between that 3 to 3.5 Henry Hub, I think you'll see us grow slightly in that single-digit production level. If we're below $3, we're going to toggle back our CapEx and kind of just gently decline. And if we're north of 350, we're going to be a little more aggressive into that mid to high single-digit growth. So it's really a function of where we see prices. And right now we see them in that 3 to 350 land. And so you can imagine we're slightly growing production next year.
Yeah, so you have raised $270 million. I'm curious to hear how you're planning to use some of that proceeds and whether it involves potential acquisitions that you might be looking at right now.
Yeah, well, our plan out of the gates is just to kind of delever our balance sheet. We believe having, you know, real low leverage out of the gates gives us huge flexibility, Scarlett, as we look at sort of that landscape of M&A or organic growth. You know, we've got tremendous inventory in the Barnett with refracs. We're the America's leader in refracs of the last 3 years in the cumulative number of refracs we've done, and we can drill up to 500 wells. So we've got a good inventory. Organically, we can deploy it. Inorganically, like you said, the Barnett is full of smaller players that we have potential to, you know, acquire at some point, and having that low levered balance sheet gives us that flexibility. So that's really how we see the business.
Yeah, I'm curious whether the interest rate cuts that we got last week and perhaps that we might get in the coming months sets the table for a more aggressive M&A approach.
Well, so BKV has been an M&A engine. We've done 19 transactions. We built our portfolio through M&A, buying first Devon's position in the Barnett and then XTO/Exxon's position in the Barnett. So we know how to do M&A. We're poised for it. We're always leaning in if there's good opportunities, and we'll be ready. You know, as you said, with interest rates where they are, with the markets where they are, we think there will be good opportunities in the horizon, and delevering our balance sheet gives us that flexibility to go after those opportunities.
All right, BKV CEO Chris Kalnin, thank you so much for joining us from the floor of the New York Stock Exchange, where the stock is currently up about 2% at $18.34 after IPOing at $18 a piece. Now, coming up on Bloomberg Markets, we're going to talk about commercial real estate. It's hit a rough patch in recent years, but our next guest company has invested $85 billion into properties. BGO President Amy Price joins us next to share where she thinks the bright spots are. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. Now that the Federal Reserve has finally cut rates, commercial real estate developers are hoping a return of liquidity will follow. A forecast by the Mortgage Bankers Association expects commercial real estate liquidity to be up more than 25% this year. So for more on what's next in this space, let's bring in Bloomberg Markets correspondent Abigail Doolittle, as well as BGO President Amy Price. Abigail and Amy, thank you so much. Amy, let me just put this to you. We know that buyers and sellers in U.S. commercial real estate are feeling a little bit better now that the Federal Reserve has finally cut rates. Do you think we're at a bottom, that we've reached an inflection point?
Yeah, it's a good start. I do think that in many sectors, and I'm going to put office aside, we do feel that we're at a low point now. Like you said, the rate cuts have started, optimism is returning to the market. And we're seeing more transaction activity. We're seeing it on the credit side with loan pools, and we're seeing it on the equity side with bidder pools. So it does feel like we're hitting an inflection point. Again, office is kind of the outlier to those comments.
So if the overall environment coming into the rate cut, Amy, had been pretty stagnant, logjam, not a lot happening, and now we're seeing a little bit more, it sounds like we're still in the bottoming process. How many more rate cuts are required to really lift this cycle, and how long does that take?
Yeah. The rate cuts, I think they're going to take a little longer, and I think the cycle is going to take a little longer. But what's interesting about real estate is I think there are some interesting opportunities, regardless of where we are in the cycle, that are more secular driven. And that's really where we're focusing and finding opportunities in the sector.
So how does that process start for you? Is there a fundamental decision? What is your philosophy in terms of making that decision? And then what sectors do you really like in this challenged environment? Because I imagine you're being super selective.
Super selective for sure. So what I'd say is we look for those opportunities is where is commercial real estate actually critical to some of the other just bigger, broader secular trends and growth. So take technology, right? We all know that we've got AI, we've got data storage, automation, robotics, all this is going on around us. What's really interesting is to think about where is physical real estate an important part of the infrastructure that it's going to take to actually drive that productivity and unlock that value. So I'll give you a couple examples. One, everyone talks about it, but I have to mention it because it's just a good, crisp example, is data centers. So for sure, we understand that we have AI, we understand the need for data storage. I think sometimes we get a little bit confused, myself included, and you kind of forget that when we talk about the cloud is not in the sky, right? The cloud is in the ground, the cloud is in a data center. And data centers are the physical real estate that we need to unlock the potential of productivity across the economy. And another example, sorry.
Go ahead.
I was just going to give one more example, which is a little different, which is just broadly speaking in industrial. So again, you've got automation and robotics disrupting the supply chain of products. You have e-commerce disrupting the supply chain of products. But what's interesting is real estate is that physical link that is necessary. And what's different now is that we need modern infrastructure, right? We need modern warehouse and distribution facilities. And 70% of the real estate in the industrial space that exists today is more than 20 years old. And it's not really conducive to the demand that we are seeing in, again, the evolution of that supply chain and the ability to put robotics in buildings.
Right.
So we see opportunities there as well.
I like how you're looking at where demand is greatest and trying to meet that. And I suppose one other area where there's a lot of demand is in residential property as well. What does that look like for you, given where we are? Because there's certainly a lot of demand and there's not enough supply.
Absolutely. It is one of the large opportunities and honestly large challenges as well. We are massively undersupplied in this country for housing. The problem or the challenge is being able to own and create the housing that is going to meet the demand of the future. So it's about market selection. We are using AI and data analytics to try to predict better where population growth, where migration trends happen, so we can be building and delivering and owning the residential real estate that is necessary for demand going forward.
You know, Amy, this affordability crisis in housing seems so extreme. I mean, this is one of the first years people can remember it's a major topic of the presidential election cycle. Is it even possible to bring enough housing online over, say, the next 5 to 10 years to stem it significantly?
I think it's going to be hard, and I think for that to happen, we really need to think about it more as a public and private partnership. Right, private capital, the real estate sector alone can't do this. We need to look at more ways to work with local governments kind of on the ground with incentives and other structures to help deliver the housing that we need.
And then, Amy, it's not just sectors of real estate, it's also geographies. And I understand that Asia is relatively strong, but what's so interesting about this, China, that property market, we hear that it's really tough. So square for us why Asia is outperforming the US and Europe.
Well, again, Asia is a large place, so I would probably restate that again. And like you pointed out, China has its challenges. We're not significant investors in China. But in other areas of Asia, for example, Japan, where we are very significant investors, very different fundamentals, right? Very different macroeconomic environment, but also from a real estate perspective, much different demand for real estate. So again, if you just think very quickly about office as one example, there was never an issue getting employees back into the office in Tokyo. So those are the type of opportunities where Asia is functioning very differently, particularly in real estate markets, than the rest of the other regions of the world.
BGO President Amy Price, really appreciate your joining us today, as well as Bloomberg's Abigail Doolittle. Thank you so much. And I'm Scarlett Fu. That does it for Bloomberg Markets. This is Bloomberg.